So Africa, Namibia specifically, what are the grades like in relation to the Athabasca, Australia, Kazakhstan? And how does that affect your numbers? You're the economist.
So, thank you. They're polar opposites to Athabasca. So Namibia is able to reliably operate uranium mines at amongst the lowest grades in the world. And there's a couple of aspects to that. The first one is where you've got to ask yourself why the country's been able to do that for more than 40 years. And it's because the other associated costs are very low. But also, the mineralogy and the consistency and the sheer volume and scale of these projects is very, very large. So they have the benefit of economies of scale. And it's very difficult to compare with Kazakhstan and other ISR projects because still it's the hydromineralogy that's the most important thing for ISR deposits. Grade comes a long second to permeability and consistency when it comes to an ISR project. So it's a little bit like apples and oranges to compare. So the other thing that I'd say about operating in Africa with a low-grade deposit is, unlike copper or gold, for example, you do start to have diminishing returns with grade in the uranium space. And that's because of the complexity that comes through the radionuclide side of things and the radioactivity and the various steps and safeties that take associated with that. So when you've got an open pit, large scale, lowish grade mine, you have to be absolutely responsible about it, but you don't have the cost imposts associated with dealing with the radioactivity that you do in, say, a high-grade underground mine in the Athabasca Basin. And that's why McArthur River and Cigar Lake, I think they've still got the highest value per tonne of any commodity for any industrial mine in the entire world. And yet they still just sit there at the top of the first quartile in our industry.
Right, okay. Okay, I mean, I guess it's a much more technical answer than perhaps someone as limited as me would be capable of understanding. But at some point, maybe if we catch up next time, we can get into that. And I think if we look at page 33 on your presentation, you actually do a peer analysis for us, and because for me, it's about if I'm going to invest in uranium, I'm a believer in the uranium story. Who do I invest into? Who's most likely to be able to deliver profitability? It's a pure numbers game for me, but it's always interesting to understand technically how what the company has to overcome and is its ability to be able to deliver against that. Perhaps we can touch upon that on page 33 in a second, certainly in relation to the peer analysis. But let's just go through the presentation. You talk about strategic appeal. So Tango is the largest unaligned uranium project with a feasibility study. So by unaligned, I assume no one's forward bought any of your assets. They don't own any equity. You are independent to some degree, obviously shareholders. Mm-hmm. So why do you make that analysis? Why is that sort of interesting?
I think it's very interesting because what we do know really about any sector, but particularly uranium, is what follows the early stages of a recovery from bear to bull market is consolidation. Mm-hmm. And consolidation is particularly acute in the uranium sector because of the security of supply dynamic and all of the imperatives that follow that. So if we look at the last uranium boom, what we saw was all of the usual factors of commodity consolidation. We saw the majors trying to look bigger than each other. We saw the mids trying to become majors. We saw companies with single or multiple commodity exposures looking to diversify into other exposures. But what you also have on top of that in uranium is you have the role of the sovereigns. Predominantly sovereign countries wanting to secure their own energy needs, but also sovereign supported integrated nuclear power producers or vendors looking to secure the fuel going forward.
Right.
And that's where the non-aligned factor becomes so important, because if you want to try and look forward and estimate who's going to be attractive when the consolidation range starts, in other words, who has that strategic appeal that will obtain a premium over the boats that are lifted by a common rising tide, that becomes extremely important, as does the scale of production, as does the long life nature of the asset, as does its position in Namibia. So that's why I say that we've got exceptionally powerful strategic appeal with both the Tango and Bannerman.
And you don't have any consideration as to whether you're selling to US, Russian, China, or other interests. This would just be a transaction which is about the economics.
Well, we're in a position to look pretty much to anyone in the world, or rather, I'd put it that anyone in the world can look at us. And that's the unique appeal that we've got being in Namibia. If you were to, let's take China, because they've clearly got the most voracious appetite for uranium and uranium projects going forward. China's going to have a hard time investing in Australia because of the Foreign Investment Review Board. They're going to have a very hard time controlling anything in Canada because Ottawa doesn't allow majority control by foreign companies in their uranium sector. I think it's pretty clear that they find it hard in the US at the moment with all of the geopolitical and nationalistic fervour that we've got going on there. You then look at Niger. Well, Niger is so tightly protected and controlled by the French that it would require a bilateral agreement with Paris to start stepping on those toes at any sort of scale. And then you run out of countries that have got any sort of relevance to the uranium sector, given that Kazatomprom necessarily by law controls all of the uranium deposits in Kazakhstan. And the same can be said for India, and the same can be said for Russia and South Korea and UAE. They can all come to Namibia. We have Russian companies in Namibia. We have Indian companies in Namibia. Clearly, we have Chinese companies in Namibia as well with Husab and then Rossing, and their investment into Langer Heinrich. So it is unusual, it is unique, and it's both the asset is attractive to those groups and their balance sheets, but also the jurisdiction is really an open door that doesn't exist in many other parts of the world. That's
interesting. So, you know, the next bit of your presentation talks about it's an advanced asset, and if people go to page 26 of your presentation, get it from your website, there's a nice chart there which says you're up there. You're as far as you can go with this project without actually getting into production. So what's next? Let's say the market comes back online. Let's say the price gets to $60 or whatever it gets to that's economic for you to kind of move forward with this project. Is it focused on your one asset, one country, non-diversified risk approach? Or do you have to go out there and speak to, or go and discover more? Or do you go to an Orano and say, hey, you've got some assets. Why don't we JV, or could we buy one of those off of you? I mean, what's the future look like, assuming all things are great in the spot market and contract market?
Well, the future for a Tango, because it's so advanced, large and technically simple, would be to move forward as quickly as possible once we have the price signal that we require.
Sure.
And the next steps on a Tango, we've been undertaking a DFS update for some time. We're making time our friend there. The more time we've got before that price signal, the more work we can do and the better return on investment we can get for our internal resources that are being deployed there. But equally, it doesn't make sense to draw that process to a conclusion, go out to fresh procurement and produce a new DFS number until we're ready to finance. Number one, it could go stale if things take a little bit longer, but number two, you get much better prices and offers out of vendors if they know you're just around the corner and they're in the running.
Yeah, I guess what I'm trying to weigh up is I'm assuming the price comes back. I'm assuming you're able to raise finance at a rate which you're happy with, or both sides are happy with. You're going to move into production, and you can either eyes down, focus on your one asset, or now might be the time to start having conversations about future acquisitions, given where some companies are at, how you view certain assets and your experience in Africa. Is that any part of your thinking at the moment, or do you want to just get step one done first?
So I don't think, Matt, that they're mutually exclusive. I think from where we're at the moment, we don't have any investment decisions to make to continue a Tango going forward. all of the work's being done. As I said, there's a little bit of work to be done wrapping up the DFS update, but that's something to be done for hundreds of thousands of dollars, not millions, in a couple of months work. And then it's into financing. So that could be done either in conjunction with, or it could be interrupted by some sort of a consolidation activity. And what I think, and I'm speaking really on behalf of the industry as a whole rather than Bannerman's board specifically here, but I think the uranium sector needs consolidation. There are too many single asset companies who are promising the world to utilities, and the utilities are not miners, they're not mining investors. They don't have the sophistication to really see through all of these promises and rank and decide and evaluate who's a real producer, who's got a real asset and who doesn't. So one of the problems that we face as an industry is they think there's a world of supply of uranium coming down the funnel at them. And people like you and me and those involved in the sector know that that just ain't the case. And consolidation is one of the things that will help to sort that problem out and help to create a more realistic picture of what supply is actually available.
That's interesting. That's interesting. You know, because if you look at the way the market has performed in the past, when the prices are high, you get lots and lots of uranium companies. When it's low, everyone sort of falls by the wayside, and you're left with a few. But you're saying with the 50 or so companies, I'm talking producers down to explorers at various stages, you think there's still room for consolidation in there?
Most definitely there is.
Okay.
And it's healthier for the nuclear industry as well, because
I'd agree.
Producing a pipeline of assets that can serve it over the next 50, 60, 70 years, rather than skyrocketing prices, bringing on another glut of production, and then here we go again.
I would agree. So tell me what you mean by, looking at page 28, Bannerman has low technical risk. I mean, you've got low technical risk because uranium is low technical risk, or are you saying that you specifically have low technical risk?
Very much us specifically. So we touched on grade before. So we do operate with relatively low grade, and that affects our economics. I would argue that it shouldn't affect an investment decision. Your investment decision should be based on economics, potential returns, and therefore risk. Grade is just one of many factors that comes into that economic decision in our DFS numbers. So the low technical risk, it resides in several things. And I would define is what are the risks that this project is unable to produce uranium in the quantities it claims when that uranium is required. So if we run through the list, first of all, the ore body is incredibly consistent and simple. I'd call it boring. The mineralogy is almost entirely consistent throughout the entire deposit. We get about 96% of the uranium from the one single mineral. The volumes are vast. Some of our intersections are continuous over more than 280 meters, for example. Because of that, the strip ratio is low. It outcrops, and both the strip ratio and the internal dilution is very low. We can control that even further through radiometric sorting on the trucks. But the more important things, the metallurgy is very simple. We will adopt a heap leaching process. And as I mentioned, we've tested that extensively with our demonstration plant with very, very good recoveries.
Okay. Can I ask then, so you mentioned something earlier. You said that you're probably higher up the cost curve than some. So how does this low technical risk, ease of operation, bulk tonnage operation marry up with that higher cost? Is it just because of the grade?
Correct.
Okay.
Yeah. The grade is pulling our cost up, and everything else is keeping it at a level that's reasonable and at a level that keeps the economics robust.
You're still going to make money, and because you've got volume of ore, you're still going to make money, but it's going to be, I mean, looking at your projected IRR, it's about around 15% at the moment. I'm sure you'll optimize that at some point further down the line, which, puts you at the, let's say low end compared to some of the peers that you put yourself up against. But you do have a heck of a lot more resource than most.
Well, we do. It is a very big project. And so that gives us what I would say is more related to strategic appeal both to sovereigns but also to utilities, both in the way that the asset would hold itself in a consolidated group. And one of the things that's most important for uranium mine is mine life, both from your customer's point of view, but when you think about how much investment of various types of resources is required to get a uranium company and a uranium project going, with environmental approvals, social approvals, all of the infrastructure required to export Class 7 ships, etc., etc. You don't want to be doing that for only 10 years. You need to get a return on that distributed resources output over a long period of time. And we have that. There's plenty of material under the pit that's not included in the resource. It just doesn't make sense to drill that deep at the moment.
Can I ask, what with regards to your DFS, what price is the uranium in at? I can't see it, or it probably is in your presentation, I just can't see it. What?
So initially, for the first 5 years, we would produce at a cash cost of $33, which increases after 5 years. But the overall break even is $52 after paying off capex and so on.
Okay.
So we need to see a recovery in the sector before we would even contemplate financing this project.
Okay, understood. So I guess the two variables which you can't quite control are grade, but you've got a sort of sense through your drilling of what it currently is, but it may improve, it may go down, but you can't control that, and you can't control price. What you do seem to have a lot of is ore and large reserve, and you're ready to go. So does that help me understand what you use a phrase here? It's called, you've got substantial value backing, and by that do you mean data?
Yeah, data that's come at a cost of 360,000 metres of drilling, for example. Whether you look at it from what's been spent, we've spent about $80 million on the project versus Australian dollars versus a market cap of 50. We've extracted very good data for that. We've got a lot of resources, we've got a lot of reserves. So I would talk in terms of those factors, gives you good confidence as to what's represented by that 50 million market cap as we stand today.
Right. Okay. And given that, we mentioned earlier, I mean, the price is important. It's important for everyone. But if the price comes back to where people want it to get to, everyone's making money. It's just a question of how much. You've told me you needed to get to about $52 to be, for your all-in cost. You think it's going to get 35, 40 by the end of this year. So when do you, again, asking you to put a pin in the map for me, when do you think it's going to get to that point where Bannerman can start thinking about either raising the capital or getting into production?
So that'll very much depend on the trajectory of long-term contracting. What we would need to see is the established lower cost producers, most notably Cameco and Kazatomprom, exhaust their contracting inventory, which means that the utilities would need to then start outbidding each other for what is a fairly small amount of remaining current production and start bidding into new production. Now, that's not going to happen in 6 months. It probably won't happen in 12 months. It could happen after that if we see the type of trajectory that's the more optimistic view on that. If it takes longer, then it'll be driven by both that dynamic with existing consumers of uranium, but also through stockpiling ahead of nuclear build programs that we're seeing just around the corner in China and elsewhere.
Okay, that's interesting. Now, given that timing that you've outlined, you've got a very good share register. You've got some big names in there. What's your burn rate at the moment? I mean, how long can $7 million get you through to before you need to go back to your shareholders and say, hey, we just need a bit more. You can sort of see where this is going, and be able to raise some more capital.
Well, that's a good point. Thank you. We're burning about $500,000 a quarter, okay, which includes a reasonable amount of spend on the asset itself. Like last quarter included drilling and DFS update work. We still have potential to reduce that, and we could, but we're at that fine line between maintaining enough corporate infrastructure to be nimble and responsive and able to react to changes in the market, and going down a path where you lose all of that in favour of greater cash longevity. So we've still got at least a couple of years of runway that we can extend if we saw a market behave in a way that's different to what we expect.